Hello, turtles, and welcome back to my new video. In today's episode, I will show you a strategy that I use to screen the markets. And the very best thing about this strategy is that it requires absolutely no indicators. I mean, of course, if you want, you can pair it with some of your favorite indicators, such as the Ichimoku cloud, for an example, here. But it will be just as powerful if you don't use any indicators. For my personal preference, I use the Ichimoku Cloud. I'm not sure if you have already seen my video, but I use the Ichimoku Cloud the following way. When the prices are above the cloud, I generally buy. When the prices are below the cloud, I generally sell. And some people say that you shouldn't trade in the cloud. However, I do trade because I noticed that most of the time when the price enters the cloud, it usually goes through it. Now the price may return or it may continue, but usually this window gets covered by the price. So what is the strategy? Well, I call it the 3-day rule. So basically, if you go here, let's just say that we start from here. So basically, the idea is to find the most recent low or high. So I'm on the daily chart, and let's just say that we are in this area. So here, as we see, we have the most recent high is this candle right here. So at 34.19, and when you detect the most recent high, you basically count 3 days and see what's going on. So here you have the first day after the most recent high. The price basically did not move at all. Then the price continued going down the second day, and the third day it went even further down. So that means that this area is most likely a good selling point. So therefore, I would have sold here and see what happened next. The price fell a lot. And I also use the Ichimoku cloud to confirm the trend, because the price was below the cloud, as you can see from here. And this is why I would have definitely sold here, and I would have gotten some decent profit. So here, as you can see, the price went down, and at this point, and here the price did a daily low. So after this candle, there was another bullish candle, which represents 1 day, another bullish candle, and then there was a third bearish candle. However, the third bearish candle did not break the previous low. So from the strategy, as you can see, you must detect all the time the highest high and the lowest low and see if the price will break the corresponding level in 3 days. If not, then the price will probably go in a different direction. I wouldn't have bought right away because, as you can see, the price is still below the cloud. So I didn't have a cloud confirmation. But let's say right here, as as I previously mentioned, as I previously mentioned, the price right here started to enter into the cloud. So here we have the cloud entry, and here we had a the highest high, and was the lowest low. So what happened here? The highest high was broken on the first day after the closing of the candle, and then on the second day the price went down and it actually broke the lowest low. So I would have stayed out of the market here. So and this this is my new lowest low candle. So I would count another 3 days. So on the first day, the lowest low was not broken. Same for the second day. The third day was a bearish candle, but still the lowest uh, candle was not broken. And on the fourth day, I would have bought here because the price is inside the cloud and the previous low was not broken. And as you can see, the price went up and it went through the cloud eventually. Same here. Now, after the closing of this candle, as you can see, this is the new highest high. And what happened in the following 3 days? Well, the price uh, fell down the second day. The third day, it went back a little. It went back up a little bit, and on the third day, it fell down. So I mean, I wouldn't have entered right here. And since we are above the cloud, we are looking only for buying positions. So on the fourth day, the price went down a little bit, but it closed positive. It closed in the green. So this would have been my lowest low candle, my most recent lowest low candle, and I would count again 3 days. So what happened on the first day? The price went up. On the second day, the price went up again. On the second day, the price fell down a little bit. Sorry, on the third day, the price went down a little bit, but it doesn't matter because the most recent low was not broken. So I would have bought right here. And as you can see, the price went again in the upside direction, and this was like a profit of 200, 200 or maybe 300 pips, which is not bad at all. So to resume the strategy, you can use you can analyze only the price action, or you can pair it up with a with your favorite indicator. It uh, it has it can be the Ichimoku cloud or maybe some other indicators such as the MACD. And when you look at the chart, you're looking for the most recent daily high and the most recent daily low. So when you find your most recent daily high, you count 3 days. If your daily high is broken, then most likely the price will go in the opposite direction. If your daily low uh, is not broken after 3 days, then most likely the price will continue going up. As every strategy, the direction of the market cannot be determined cannot be determined 100% of the time. Sometimes you will get false signals, and as I always say in my videos, risk management is the most important thing that you should focus on your in your trading career. Please pair this strategy with small but frequent positions, and you might get some decent trading results. Thank you very much. If you like the video, please make sure to like, subscribe, and leave a comment if you have any questions. Goodbye and have a nice day.